DeFi, or Decentralized Finance, is a movement that aims at making a new financial system that is open to everyone and doesn't require trusting intermediaries like banks. To achieve that, DeFi relies heavily on cryptography, blockchain, and smart contracts. It's undoubtedly become one of the most important aspects of the recent crypto movement, but it also does come with some notable risks and considerations, which is why we've come up with the following video outlining everything you need to know about DeFi. Number 1. What exactly is DeFi? The use of technology in financial services is not new, as most transactions at banks or other financial services companies are accomplished with the help of technology nowadays. However, the role of technology is restricted to being a facilitator of such transactions, and so companies still have to contend with navigating a variety of factors, such as the legalese or jurisdictions competing financial markets and different standards to make a transaction possible. With its stack of common software protocols and public blockchains to build them on, DeFi places technology at the front and center of transactions in the financial services industry. DeFi is commonly placed in the domain of blockchain and cryptocurrencies, but its scope is much wider than this. Modern financial infrastructure is built on a hub-and-spoke model. Key economic centers of activity, like New York or London, function as operational hubs for the financial services industry and influence economic activity at spokes. Regional centers or financial powerhouses like Mumbai or Milan may not be as globally important as hubs, but still function as nerve centers for their respective economies. Economic prosperity or hardship radiate outward from hubs to spokes and toward the rest of the global economy. This model of interdependency is repeated in the functioning of global financial services corporations. They have headquarters in hubs and local branches, partnerships, or investments around the world. The sprawl of their operations means that the organization itself is subject to a phalanx of laws and regulations in each of its financial jurisdictions. Their reach has made such institutions systematically important to maintain the global economy's balance and necessary to maintain or create new financial services infrastructure. Though this model worked well in the last century, the financial crisis and subsequently the Great Recession revealed the flaw in this architecture. The balance sheet problems for a couple of large financial institutions produced a domino effect of tumbling economies and the onset of the global recession. Decentralized finance uses technology to disintermediate centralized models and enable the provisioning of financial services anywhere for anyone, regardless of ethnicity, age, or cultural identity. DeFi services and apps are mostly built on public blockchains, and they're either a replicate existing offerings built on the rails of common technology standards, or they offer innovative services custom designed for the DeFi ecosystem. At the same time, DeFi applications provide users with more control over their money through personal wallets and trading services that explicitly cater to individual users instead of institutions. Next up, why would I need DeFi? Decentralized finance, or DeFi, is a system by which financial products become available on a public decentralized blockchain network. This makes them open to anyone to use rather than going through middlemen like banks or brokerages. Unlike a bank or brokerage account, a government-issued ID, social security number, or proof of address are not necessary to use DeFi. More specifically, DeFi refers to a system by which software written on blockchains makes it possible for buyers, sellers, lenders, and borrowers to interact peer-to-peer, or with a strictly software-based middleman rather than a company or institution facilitating a transaction. Multiple technologies and protocols are used to achieve the goal of decentralization. For example, a decentralized system can consist of a mix of open-source technologies, blockchain, and proprietary software. Smart contracts that automate agreement terms between buyers and sellers, or lenders and borrowers, make these financial products possible. Regardless of the technology or platform used, DeFi systems are designed to remove intermediaries between transacting parties. Though the volume of trading tokens and money locked in smart contracts in its ecosystem has been growing steadily, DeFi is an incipient industry whose infrastructure is still being built out. Regulation and oversight of DeFi are minimal or absent. Number 3, DeFi or SeFi. Along with the growth of DeFi services, centralized finance, SeFi, has also seen steady growth in demand in recent years. Despite its name, ironically, what CDI services prioritize is to become a more centralized version of traditional financial services. It's a structured and specialized financial service that allows people to get loans or earn interest on their cryptocurrency by lending or borrowing through a centralized central exchange. CeFi aims to make trades fairer, boost transaction processing, and increase buying and selling processes. The central exchange quotes their prices, thus, these are the only available price options for traders. Many criticize that centralized operation comes with many side effects, such as higher transaction fees due to third-party or intermediaries' involvement, but it actually comes with more safety pins than you might realize. Security and credibility are the key factors in providing a secure financial platform, and with a reliable yet transparent operation body, consumers can be protected against security breaches. It is the crypto asset itself that is managed with an ethos for decentralization. It may not be enough to justify sacrificing the system's stability, accountability, and user experience for the philosophy. DeFi and CeFi may prioritize different things, but their ultimate goals are the same, allowing more users to take control of their crypto assets. Also, what are the risks of DeFi? Nothing in life comes without risk, and unfortunately, as innovative and game-changing as DeFi appears to be, it too has its flaws. Decentralized finance is still in the beginning stages of its evolution, with the total value locked in DeFi contracts being more than $41 billion as of March 2021. The total value locked is calculated by multiplying the number of tokens in the protocol and their value in USD. Though the total figure for DeFi may sound substantial, it is important to remember that it is notional because many DeFi tokens lack sufficient liquidity and volume to trade in crypto markets. The DeFi ecosystem is still riddled with infrastructure mishaps and hacks, and scams are also commonly found in the rapidly evolving DeFi infrastructure. DeFi rug pulls in which hackers drain a protocol of funds and investors are unable to trade are also common, though there are well-established protocols that can significantly reduce this. The open and relatively distributed nature of the decentralized finance ecosystem might also pose problems to existing financial regulation. Current laws are crafted based on the idea of separate financial jurisdictions, each with its own set of rules and regulations. DeFi's borderless transaction span presents important questions for this type of regulation. For example, who's culpable in a financial scam that occurs across borders, protocols, and DeFi apps? Smart contracts are another area of concern for DeFi regulation. Aside from Bitcoin's success, DeFi is the clearest example of the code is law thesis, wherein law represents a set of rules that are written and enforced through immutable code. The smart contract's algorithm is encoded with the necessary constructs and terms of use to conduct transactions between two parties. However, software systems can malfunction due to a wide variety of factors. For example, what if an incorrect input causes a system to crash, or is a compiler, which is responsible for compiling and running code, errors? Who is liable for these changes? These and many other questions need to be sorted out before DeFi becomes a mainstream system used by everyone. And finally, what's the future hold for DeFi? Even while DeFi does present certain risks, there's no denying the rapid rise it's had in recent years. What does the future hold for DeFi? As you probably already noticed, DeFi is a super interesting and vibrant space that's full of opportunities. Although we have to remember that it's still a very unpredictable industry, it's a high-risk and high-reward game. DeFi is the closest thing that can actually disrupt the traditional financial industry. In contrast to most of the fintech companies, DeFi is built on the new rails instead of relying on outdated technologies and procedures. Currently, most of the financial products can only be created by banks, whereas DeFi is open, permissionless, and enables cooperative work in a similar way to the internet. Although DeFi is currently built predominantly on Ethereum, with more adoption of interoperability protocols, we may see more projects being built on different chains in the future. Put it simply, decentralized finance offers new opportunities and has a tremendously bright future. Essentially, DeFi offers solutions to 5 key problems of centralized financial systems: centralized control, limited access, inefficiency, lack of interoperability, and opacity. DeFi seeks to build and combine open-source financial building blocks into sophisticated products with minimized friction and maximized value to user. Since it costs no more to an organization level to provide services to a customer with $100 or $100 million in assets, DeFi proponents believe that all the meaningful financial infrastructure will be replaced by smart contracts that can provide more value to a larger group of users. Outside of a few technical issues, DeFi has all it takes to fully tokenize and decentralize the world's financial system if it's allowed to evolve. This may collide with governmental interests, but if we take into account 1.7 billion unbanked adults and the growing threat of deplatforming in the developed world, this should serve as a strong force to drive DeFi across the new threshold. And with that, it wraps up the video. Thanks for watching.